Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about the current state of capital markets, where we think capital markets will be going over the next little while. And we're at a very, very important inflection point in terms of the economy and how we should be handling our retirement portfolio. So I think you'll enjoy this particular video. Now, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content. And if you like the video, make sure you hit the like button. Now, we've gone through an absolutely extraordinary period in capital markets and economic markets over the last 18 months to 2 years. And it's been surprising, I think, for many people to see how equity markets and stock markets have fared over the last year, given the volatility, the uncertainty, and the craziness around COVID and its impact to all of our lives. But really, when we reflect on it, it shouldn't be completely crazy, because there have been a few factors, probably three main factors, that have been very supportive to markets over the last little while. The first factor has been very accommodating fiscal support. So if you look at governments around the world have been through, in Canada as an example, through what's called CERB payments, enhanced EI benefits, loan programs for businesses, and generalized program spending has been very supportive to the economy and, by extension, helpful to the stock market. Stats Canada released some data not too long ago, and it confirmed that family income in Canada was actually higher in 2020 than it was in 2019. So actually, during a pandemic, income was higher. And that speaks to how accommodating fiscal policies were for Canadian families. And that was not unique to Canada. It was something that was happening around the world, particularly in Western economies. Now, the second thing that's been very supportive has been the support by monetary policy or central bank policies. If you look at Bank of Canada, the Federal Reserve Board, you look at the European banks and global, central banks around the world, have been initiating policies to support credit markets, capital markets generally, and through policies like quantitative easing, where they buy sovereign debt, buy that debt. By doing that, they force up the prices of the bond market, and that pushes down the yield, and that's very stimulative and accommodating for the economy. So we've had extraordinary support by central banks to keep the monetary system and economic system strong and liquid. And of course, the last piece has been the one-time spend. So if you go back to 2020, where people couldn't spend because we were in lockdown, we're now in a process of people spending money. It's not a multi-year spend. It's probably a 1 year or year and a half spend, where now people can spend the money that they would have spent normally in 2020. And that's been very supportive to the economy and ultimately very supportive to the stock market. Now, as we look ahead, will those particular themes continue? And I would say that probably not. So we're going to see, probably for governments, particularly in Canada, as we go into the election over the next few days, we'll probably see whoever forms the next government will become much more cautious from a fiscal standpoint. There's no doubt that there'll be pressure on most Western governments to begin bringing their fiscal house back in line. The amount of debt that's been taken on, the current debt loads and deficits have been extraordinary. And so that will create a situation where the fiscal support will begin to wane and will take liquidity and support out of the economy and ultimately out of the stock market. The second piece relates to monetary support by central banks. And there's no doubt that they've been messaging for a while that they'd like to move away from quantitative easing and support for the markets through their intervention and allow markets to basically run on their own. That won't be an immediate policy change, but we'll see a gradual change where that support will be lifted and moved away from. And as a consequence, the markets and the economy will have to bear the full brunt of whatever the economic situation will be at that time. And likely there'll be some headwinds for the economy as a result of that support that may not be there by central banks. And of course, the one-time spend by consumers is a one-time spend. It's not like the money that was not spent in 2020 will continue to be spent at the same level every single year. So we've got this massive spending that's going on now, and there'll be a dissipation of that spending over time. And then finally, inflationary pressure is going to be significant. We're seeing very significant inflationary pressure. That will be putting a bit of a dampening effect on the economic growth, and has pressures on certain sectors of the economy as it relates to the stock market. So there are definitely strategies to employ in your portfolio, whether it's making sure you're doing some profit taking right now in anticipation of these headwinds, whether it's moving from what are called cyclical sectors like consumer products or energy or that kind of thing into sectors like utility stocks and other sectors that are more resilient, sectors where we need to buy those products and services in good markets or bad. There's a very important repositioning of your portfolio, your retirement plans that you need to begin considering as you go into the next phase of the economy. Anyway, it's my hope that you found this particular video helpful, and in the description notes, show notes for this video, there's some links to our website. They'll take you to a resource page for retirement planning services and other programs that we have. If you want to reach out to us, there's a link to our contact page. Don't hesitate to do that if you want some second thoughts on your portfolio or some advice on your current planning. Anyway, you take care. All the best in your retirement and wealth planning. Bye-bye.